All right, let's talk about income. Jim Seacott here with Polaris Mortgage Planners at Axiom Mortgage Solutions. Now with income, there can be required a little bit of paperwork for this to prove this to the lenders. And we break it down into employed, self-employed, and whether employed, whether you're guaranteed your hours or your salary, your wage, or if it's non-guaranteed, and or if it's commission. So let's break this down. So employed people. So if you are guaranteed your hours, your salary, or you're guaranteed your hours, then there's a consistency of your payment every week, every month, every year. Then we can, with the salaried, there are some lenders where we can just supply a job letter and a most recent pay stub, and that's enough. But more often than not, they want a job letter, a pay stub, and also your last 2 years of notice of assessments. And that's what the government gives back to you once you've submitted your tax return, and they go through it, and then they send you back your notice of assessment saying how much you claimed for income, what your taxes are, and whether you still owe taxes for the year, or if you're getting a refund back, and then how much RSP room you have and such. So that document, that's your notice of assessment. Make sure you keep that on file so that we will need that when we are qualifying you most often. So that's for guaranteed income. Now, if we're talking non-guaranteed hours or commission, or you're getting bonuses, extra money every year that's not guaranteed, and we want to use that income, then we'll want your job letter, your pay stub, your last 2 years of notice of assessments. And what we'll do is we'll take those notice of assessments and we'll average out what you earn on average each year, as long as that's a steady amount or an increasing amount. If it's decreasing, if your most current year is lower than your previous year, then we have to take your current year, because it's a decreasing balance and you're trending down, so they don't want to take the average because that's higher. They'll want to take your current year. Now with self-employed, we then have, and one other thing on the employed is if you're not guaranteed the income, or you are, but you're new to a certain job and you've moved around the last few years, you can have where there's tradespeople or people working at unions that move around quite a bit, and they'll typically want to see the T4s from those different jobs that you worked at. So we might want those T4s for the last couple of years, and possibly your T1 general, which is your tax return that you send into the government. So that's the big long, it could be 10 to 20 to 30 pages long of what your accountant or yourself had submitted to the government, and then they give you back the notice of assessment. So we might want your T1 generals as well as your T4s for the year. Now when you go to self-employed people, it can be sole proprietorship, where you don't have a corporation, you're just operating as yourself, maybe with a trade name, or you could be in a partnership, or you could be in a corporation. Now, as with sole proprietors, we'll be looking for your T1 general, and might even want to see your bank statements. So your T1 generals for the last couple of years of what you filed for taxes, your notice of assessments, what the government's given back to you for the assessment, and then your bank statements sometimes, because they want to see the money you've been making for the last little while in your bank account. And with that, with a self-employed person, we can sometimes bump up your income by 15% because you are tax efficient. There are certain things that you can write off. If you're working out of your household, if you got a vehicle but you don't really need it, but you're like for the job, but you're writing it off. And sometimes we can add some of that stuff back into your income because you've written it off for your income. So we'll take your net income and add those things back. Or we can take your income and we can bump it by 15% as a flat amount, and see which one ends up being better, and try and use that for your income for qualifying. With the corporation or partnership, we gotta add some paperwork with the partnership or the corporation, the business financials. They'll want to see a couple years of financials to see how the business has been doing, to see the corporate search to see what the ownership is and how much ownership you have of that company. And then again, they might want to see business, the bank account with the money, transactions within the bank account for the last 6 months, let's say, or so. And they'll use that to kind of judge the health of the business. So that's with your regular income. And then if you are collecting child care benefit from, you have some children, you're getting that from the government, we might want to use that. So some lenders let us include child care benefit to a certain point. 15 to 30% of your overall income can be from the child care benefit, let's say. There's a few that let us go a little bit higher, but generally that's the rule. And they'll want to see the birth certificates of the kids, because once they're over 12 or 13 years old, that child care benefit will run out when they're 18. So if you're getting a 5-year mortgage, you wouldn't be getting that money anymore by the time that term was up. So they'll want to make sure the kids are usually 13 years or under that, or 12 years. And then what else is, they'll sometimes want to see the from CRA the document that you have someone registered and getting the child care benefit, and how much that is. The monthly amount, it'll show on your CRA portal on the My Account when you log into CRA. And they might also want to see the last 3 months within your bank account, that child care benefit hitting your bank account each month. Then we got rental income could be something else. So if you have rental properties, we might be use some of that to help offset the cost of the rental properties. So there's paperwork involved with that. And some lenders want to see it reported on your T1 General. So the tax return you send in the government, if you're reporting those properties on your T1 General under the statement of real estate activities, then we can use that to help offset some of those costs. So that's about it. If you have any questions on the income stuff, we'll definitely talk about that. We'll let you know what we need for documentation, and then we can help qualify you for the most amount that we can with the income that you're making. And another important thing is that your income taxes have to be paid. They want to make sure that, and that's another reason why they ask sometimes for the notice of assessments, because it'll show whether you owed income taxes or not. And then we just got to show proof that you've paid those income taxes. All right, so that's some information on income and getting that qualified. Jim Seacott with Polaris Mortgage Planners at Axiom Mortgage Solutions. Give me a shout and we'll take care of it.